October 19th, 1987, 9:30 a.m. A New York stockbroker picks up the phone. His client is screaming, not yelling, screaming, "Get me out! Get me out now!" The broker tries to execute the sell order. The system is frozen. He tries again. Frozen. The client is still screaming. On every screen around him, numbers are falling. Red, red, red. The Dow Jones has dropped 200 points in 15 minutes. By lunch, it will lose 508 points, 22.6% of its entire value, the equivalent of $500 billion vanishing in 6.5 hours. It's the largest single-day percentage decline in stock market history, and nobody knows why it's happening. I'm back with another deep dive into financial history, and this is the story Wall Street doesn't want you to fully understand. Because Black Monday 1987 proved something terrifying. The market can collapse for no reason at all, algorithms can panic, systems can fail, and your money? It's not as safe as you think. Hit subscribe if you want to understand how modern markets actually work. Let's go back to October 1987. Let me take you back to October 1986, 1 year before the crash. Ronald Reagan is president. The Cold War is still on, but America is winning economically. The stock market is on fire. I mean absolutely on fire. The Dow Jones Industrial Average, the main index tracking America's biggest companies, has gone from 1,000 points in August 1982 to 2,700 points by August 1987. That's a 170% gain in just 5 years. To put that in perspective, if you had invested $10,000 in 1982, you'd have $27,000 5 years later. That's life-changing money for ordinary people. And everyone knew it. Your neighbour was getting rich. Your co-worker was getting rich. The guy who delivered your mail was talking about his stock portfolio. This wasn't just Wall Street anymore. This was America. The American dream was playing out in real time through the stock market, and everyone wanted in. This was the era of greed is good. Everyone wanted in. You know that movie Wall Street with Michael Douglas? That came out in 1987. Gordon Gekko's famous speech about greed being good, about greed clarifying and cutting through. That wasn't fiction. That was documentary. That was the actual culture on Wall Street. Traders were making $500,000 bonuses at age 28. Not salaries, bonuses, on top of their 6-figure salaries. Let me paint you a picture of what that looked like in real life. Walk into Smith & Wollensky Steakhouse in Midtown Manhattan on any Thursday night in 1987. Every table is full of men in their 20s and 30s wearing custom suits from Barney's. Rolex watches, slicked back hair. They're ordering $200 bottles of wine like it's nothing. Appetizers, steaks, desserts, after-dinner drinks. The bill for 4 guys might be $800, $1,000. Nobody cares. They're splitting it 4 ways and expensing it to the firm. Or they're just paying cash. Because when you made $400,000 last year, what's a $250 dinner? The conversations at these tables were always the same. Deals, trades, markets, who made what, who lost what. Gossip about which firms were hot, which traders were getting poached, which CEOs were getting taken over, which companies were targets for leveraged buyouts. It was shop talk 24/7. These guys didn't have hobbies. They didn't have outside interests. The market was everything. Trading was everything. Money was everything. And they were spending it as fast as they made it. Porsches and BMWs in their parking spaces, co-ops and condos in Manhattan selling for prices that seemed insane. $500,000 for a 2-bedroom. That was cheap. Try $800,000. Try $1.2 million. And they were bidding against each other, driving prices higher. Real estate agents loved them. Car dealers loved them. Everyone who sold luxury goods loved them. Because Wall Street was printing money, and the guys printing it were 26 years old with no wives, no kids, no responsibilities except showing up at 7 a.m. and leaving at 8 p.m. 5 days a week. The drug use was rampant. Cocaine was everywhere. Bathroom stalls at nightclubs, in the meatpacking district, desks in the offices after hours. It kept you awake, it kept you sharp, it kept you going when you'd been working 15-hour days for 6 weeks straight. Nobody talked about it publicly, but everyone knew the SEC didn't care. The firms didn't care as long as you made money, and you kept making money, so the coke kept flowing. This was the 1980s. Rules were suggestions, laws were obstacles to work around. The only thing that mattered was winning. But the traders weren't the only ones making money. Corporate raiders were becoming celebrities. Carl Icahn, T. Boone Pickens, Nelson Peltz. These guys would target undervalued companies, buy huge stakes, threaten hostile takeovers, and either force the company to buy them out at a premium or actually take over and break up the company for parts. It was brutal, it was efficient, and it was wildly profitable. The most famous example was probably R.J.R. Nabisco in 1988, right after Black Monday. But the trend started before that. Raiders would identify companies trading below the value of their assets. They'd borrow massive amounts of money, leveraged buyouts they called them, to buy the company. Then they'd sell off divisions, fire employees, slash costs, and extract maximum value. If it worked, they'd make hundreds of millions. If it didn't, the company would go bankrupt, but the raiders had structured the deals so they wouldn't lose much personally. The risk was on the lenders and the employees. This created a culture of fear in corporate America. CEOs lived in terror of raiders. Boards of directors installed poison pills and other defences to make hostile takeovers harder. But it also created a culture of shareholder value above everything else. If you weren't maximising profit, if you weren't cutting costs, if you weren't lean and mean, you were a target. This was the era when American companies started mass layoffs, not because they were losing money, but because Wall Street demanded higher profit margins, efficiency, productivity, shareholder value. Those were the words that mattered. The technology driving all this was changing fast. In 1982, most stock trades were still done by hand. Paper tickets, phone calls, human specialists on the floor of the New York Stock Exchange matching buyers and sellers. By 1987, computers were taking over. Not completely, but significantly. Electronic order entry systems meant brokers could enter trades into a computer instead of calling the floor. Electronic execution meant some trades could be matched automatically. And the big change, program trading. Program trading was revolutionary and dangerous in equal measure. Here's how it worked. Arbitrageurs, traders looking for price discrepancies, would use computers to monitor stock prices and futures prices simultaneously. Stock index futures are contracts that let you bet on where the S&P 500 or Dow Jones will be in the future. In theory, futures prices should track stock prices closely, but sometimes they diverge. Futures would be slightly more expensive than stocks, or vice versa. When that happened, program traders would arbitrage the difference. If futures were expensive relative to stocks, they'd sell futures and buy stocks. If futures were cheap, they'd buy futures and sell stocks. The computers would identify these opportunities and execute trades automatically. Boom. Buy 10,000 shares. Sell 500 futures contracts. Lock in the profit. Do this 1,000 times a day, and suddenly you're making millions on tiny price differences. But there was a side effect nobody anticipated. When program trading kicked in, it moved markets. If computers were selling stocks to buy cheap futures, that selling would push stock prices down, which might trigger more program trading, which would push prices down more. It was amplification. The computers were creating volatility while trying to exploit it. The really dangerous innovation, though, was portfolio insurance. This is crucial to understanding Black Monday, so stay with me. Portfolio insurance was invented by 3 finance professors, Hayne Leland, Mark Rubinstein, and John O'Brien. They founded a company called Leland O'Brien Rubinstein Associates, LOR for short, to sell this product to institutional investors. The idea was elegant. You own a portfolio of stocks worth, say, $500 million. You're worried about a market crash. You don't want to sell your stocks because then you'd miss out if the market keeps going up. You also can't afford to lose 20% or 30% if there is a crash. What do? Portfolio insurance said, "We'll protect you using dynamic hedging." Here's how it works. We install a computer system that monitors your portfolio in real time. If stocks start falling, the system automatically sells stock index futures. These futures are bets that the market will go down. So if your stocks lose value, the futures make money, offsetting your losses. It's like buying insurance on your house, except instead of paying a premium, you're using a computer algorithm to dynamically hedge your exposure. The math behind it was called the Black-Scholes model, which had won its inventors a Nobel Prize. It was sophisticated, it was quantitative, it was supposed to be foolproof. And by 1987, portfolio insurance was managing between $60 billion and $90 billion in institutional assets. Pension funds loved it. Insurance companies loved it. University endowments loved it. You could stay fully invested in stocks and have downside protection. Win-win. Except there was a catastrophic flaw. The model assumed that markets were liquid, that you could always find buyers for your futures contracts. The model assumed that markets moved in small increments. The model assumed that not everyone would be selling at the same time. All those assumptions were wrong. What happens when dozens of portfolio insurance systems, all programmed the same way, all start selling futures at the same time? What happens when the market drops 5% and every system says sell, sell, sell? What happens when there are no buyers because everyone else is also trying to sell? The answer: a death spiral. Prices fall, systems sell. Prices fall faster, systems sell more. Feedback loop, vicious cycle, market crash. But in 1987, nobody had thought through this scenario. The systems were new, the models were elegant, the professors had Nobel Prizes. What could go wrong? Let me give you another human story to make this real. Meet David. He's 45 years old, a manager at a pension fund in California. His fund has $2 billion in assets. Most of it is in stocks. His job is to make sure retirees get their pensions. He can't afford to lose 30% in a market crash. So in 1986, David's fund installed a portfolio insurance system. Cost $500,000 for the software and integration. But it was worth it for the protection. The system would automatically sell futures if stocks dropped more than 5%. Peace of mind. David could sleep at night knowing the computers were watching his portfolio. By October 1987, David's system hadn't triggered yet. The market had been going up for 5 years, but David and his team had run simulations. If the market drops 10%, the system will sell $200 million in futures contracts. If it drops 15%, it will sell $300 million. The math worked out perfectly on paper. David trusted the math. He trusted the professors who built the system. He trusted that in a crash, the system would protect his retirees. He trusted. What David didn't know was that there were hundreds of other portfolio insurance systems just like his, all programmed to sell at the same time, all trying to offload billions of dollars in futures contracts in a falling market. And on October 19th, 1987, David was going to learn what happens when elegant math meets brutal reality. Individual investors were piling into the market too. By 1987, about 25% of American households owned stocks directly, up from 15% in 1980. That might not sound like a lot, but it was a massive increase. And it wasn't just stocks. Mutual funds were exploding. Fidelity, Vanguard, T. Rowe Price. These companies were marketing mutual funds aggressively to ordinary Americans. You could invest in a diversified portfolio of stocks without having to pick individual stocks yourself. Just send them your money and the professional fund managers would handle it. And people were doing exactly that. Pension plans were shifting from defined benefit plans, where the company promised you a pension, to defined contribution plans, where you got a 401k and you picked your own investments. Guess what everyone was picking? Stocks. 100% stocks. Because stocks had gone up for 5 years straight. Because stocks always go up. That's what the past 5 years had proven. Day trading was starting to become a thing. This was before online brokerages, obviously. If you wanted to day trade in 1987, you'd call your broker with orders. Or you'd go to a brokerage office where they had electronic screens showing real-time prices. Some people were doing this full-time. They'd quit their jobs, open accounts with $50,000 or $100,000 and try to make a living trading. Some were successful, most weren't. But in a bull market, even bad traders can make money. So the ranks of day traders were growing. Let me tell you about Jennifer. She's 28, works as a junior trader at a mid-sized brokerage in New York. She makes $80,000 a year salary, but her bonus last year was $200,000. She bought a co-op in Manhattan for $350,000, a studio apartment in Murray Hill. She works 100-hour weeks. Trading floor from 9:30 a.m. to 4 p.m. client meetings and paperwork until 6 p.m. Gym at 6:30. Dinner at 8. Home by 10. Read research reports until midnight. Back up at 6 a.m. to get ready and commute to the office. Saturdays she usually goes in for a few hours to catch up. Sundays she sleeps and does laundry. She loves it. The adrenaline, the competition, the money. She grew up middle class in Ohio. Her dad was a teacher. Her mom was a nurse. Combined, they made $60,000 a year. Jennifer made that in 4 months. She was 28 and making $280,000 a year. She couldn't believe it. Every time she got her bonus, she'd call her parents. They couldn't believe it either. Their daughter, the trader, making more money than they'd ever seen. Jennifer's job was executing trades for clients, rich clients, hedge funds, pension funds. When they wanted to buy or sell large positions, they'd call Jennifer. She'd work the order, breaking it into smaller pieces, executing over time to get the best average price, using her knowledge of the market to minimize impact. She was good at it. Her clients trusted her. Her boss trusted her. She was on track to make managing director by 30, maybe even partner by 35. The sky was the limit. She was also exhausted. The 100-hour weeks were brutal. She'd gained 15 pounds from eating takeout every night. She hadn't been on a date in 6 months. She had no time. But she told herself it was temporary. Work hard now, make a fortune, retire early. That was the plan. Everyone had the same plan. Or meet Robert. He's 59, a dentist in California, planning to retire in 6 years at 65. His 401k is worth $550,000. It had been $200,000 in 1982, 5 years, and he'd almost tripled his money. His financial advisor had told him to stay 100% in stocks. "You're still working," the advisor said. "You don't need the money yet. Let it grow." And it had grown. Robert was on track to retire comfortably. He and his wife were talking about buying a vacation home in Tahoe, maybe taking that trip to Europe they'd always dreamed about. Life was good. Robert checked his 401k statement once a quarter when it came in the mail. That was it. He didn't think about the stock market daily. He trusted his advisor. He trusted the system. He had no idea that in a few weeks his $550,000 would become $400,000. He had no idea that his retirement plans would be thrown into chaos. He had no idea that the system he trusted was about to break. The physical environment of Wall Street in 1987 was intense and intoxicating. The New York Stock Exchange trading floor was the epicenter. It was a massive space, about 40,000 square feet, packed with trading posts. Each post was an island where specialists would trade specific stocks. The specialists wore different coloured jackets to identify which post they worked at. The floor brokers wore jackets too. Runners wore different colours. Everyone had a role. Everyone had a place. The noise was unbelievable. Imagine 2,000 people in one room, all shouting simultaneously, not talking, shouting, because you had to shout to be heard over everyone else shouting, "Bid 50, offer 52, 1,000 shares, 10,000 shares." The acoustics were terrible, high ceilings, hard floors, too many bodies. The sound just echoed and amplified until it was a wall of noise that physically hurt your ears if you weren't used to it. The smell was a unique blend. Coffee. Always coffee. Guys would drink 10 cups a day just to stay alert. Cigarette smoke. You could still smoke on trading floors in 1987, and everyone did. Take-out food from lunch delivered right to the trading posts. Chinese food, pizza, deli sandwiches, sweat, bodies packed together, adrenaline pumping, physical exertion of shouting and running around, cologne trying to cover the sweat, and paper, the overwhelming smell of paper. Thermal paper from the printers spitting out trade confirmations, regular paper from orders written by hand, newspapers, research reports. Everything was paper. The floor was literally carpeted in paper by the afternoon. Every trade generated paperwork. Order tickets, execution confirmations, routing slips. The runners would carry these between trading posts and the phone banks at the edge of the floor. As the day went on, the paper would accumulate. By 3 p.m. you'd be walking on 2 inches of paper. At night, cleaning crews would sweep it all up. By noon the next day, it would be back. The screens were everywhere. CRT monitors showing stock prices. Ticker tape machines printing out trade data. Digital boards on the walls showing the Dow Jones and other major indices. Everything was green text on black backgrounds, or orange text, or amber. The numbers would flicker and update constantly. If you watched them too long, your eyes would hurt, but you couldn't look away. That's where the information was. That's where the money was. The energy was frenetic. Everyone moved fast, walked fast, talked fast, traded fast. You couldn't be slow. Slow meant you missed opportunities. Slow meant someone else got the trade. Slow meant you lost money. So everything was urgent. Everything was now. The pace was relentless. Above the NYSE floor, in the executive offices of the major brokerages, the atmosphere was different but equally intense. At Goldman Sachs headquarters, at Salomon Brothers, at Merrill Lynch, traders sat at desks with multiple phone lines and multiple screens. The institutional trading desks handled the big clients: pension funds, mutual funds, hedge funds. These weren't individual investors buying 100 shares. These were institutions buying 100,000 shares or selling $50 million positions. The institutional traders were the elite. They made more money than the floor traders. They had more responsibility. They were managing client relationships worth billions of dollars. One screw up, one bad trade, and you could lose a client, lose a big enough client, and you could lose your job. So the pressure was immense, but so were the rewards. A good institutional trader at a top firm could make $1 million a year. By age 30, the offices smelled different than the trading floor. Still coffee, still take-out food, still paper, but also expensive cologne. The faint smell of leather from the chairs. Fresh flowers that were delivered to the executive floor every Monday. It was a step up from the chaos of the exchange floor, but the pressure was the same. The summer of 1987 was peak euphoria. The Dow hit 2,722 on August 25th, an all-time high. Businessweek magazine had a cover story: "Is the bull market over?" The conclusion: no, the bull market has years left to run. Barron's, another major financial publication, was similarly bullish. The Wall Street Journal published endless articles about strategies for the long-term investor. Everyone agreed this bull market was different. It was based on fundamentals. Corporate earnings were strong, the economy was growing, Reagan's tax cuts were working. This wasn't a bubble. This was the new normal. Cocktail parties in Manhattan and Connecticut and the Hamptons were all about stock tips. Everyone was an expert. Everyone had a hot stock. Everyone had a strategy. The conversations would go like this: "You should buy Microsoft. They're going public soon. I heard from a guy at Goldman that it's going to explode." Or, "I'm all in on biotech. That's the future." Or, "real estate investment trusts. 15% dividends. Can't lose." Nobody was talking about bonds. Nobody was talking about cash. Those were for suckers. Those were for people too scared to make real money. Stocks were the only game. Stocks were where you got rich. And everyone wanted to get rich. Even the skeptics were quiet. Warren Buffett, the most famous investor in America, had been warning since 1986 that stocks were overvalued. His metric, the total market capitalization of all stocks divided by US GDP, was at an all-time high. Historically, when that ratio got too high, a crash followed. But Buffett was old school. He was 57 years old in 1987. The young guys thought he was out of touch. The world had changed. Computers were changing everything. The old rules didn't apply. Buffett was sitting on cash, waiting for better valuations. The young guys thought he was a fool. They were making 50% returns. Buffett was making 10%. Who was the fool now? Some economists were also warning about valuations. Stock price to earnings ratios were around 23 by August 1987. The historical average was 15 to 16. That meant stocks were expensive. But the counter-argument was, earnings are going to keep growing. The PE ratio will come down naturally as earnings catch up to prices. You don't need stock prices to fall. You just need corporate profits to keep rising. And with the economy humming along, that seemed likely. Then came October. The first hint that something was wrong. Tuesday, October 6th, 1987. The Dow dropped 91.55 points. That was 3.8%. It was the biggest point drop in history at that time. The dollar amount was unprecedented. Sure, there had been bigger percentage drops in the past, the 1929 crash, for instance. But this was 1987. The market was bigger, the numbers were bigger. A 91-point drop was huge. Why did it drop? Nobody was quite sure. Some analysts blamed interest rates. The Fed had been tightening monetary policy. Interest rates had crept up from 6% to 7% over the summer. Higher interest rates made bonds more attractive relative to stocks, so some money was rotating out of stocks into bonds. Other analysts blamed the trade deficit. America was importing more than it exported. The deficit was growing. That was weakening the dollar. A weak dollar might mean inflation, which might mean the Fed would raise rates more, which was bad for stocks. Still others said it was just a normal correction. Markets go up, markets go down. This was the market taking a breather before the next leg up. Trading volume was massive that day. Over 176 million shares changed hands. That was way above the average of 150 million shares a day. Something big was happening. And computers were involved. Program trading systems had kicked in. When the market started dropping, the systems had automatically sold to lock in gains or cut losses. That selling had pushed the market down further. It was the first real test of the new electronic trading systems in a downturn, and they'd amplified the move. But after a day or two, the market stabilized. Thursday, October 8th, the Dow bounced back, up 52 points. See, just a correction, nothing to worry about. The talking heads on TV said, "This is healthy. Markets need corrections to consolidate gains. This is a buying opportunity." And some people bought, but others were nervous. That 91-point drop had been scary. It had felt different. Then came Wednesday, October 14th. The market dropped 95.46 points. Another 3.8% decline. Now this was the biggest point drop ever, bigger than the one a week earlier. The financial media started using the word crash, not as a prediction, as a question. Is this a crash? Could this turn into a crash? Behind the scenes, traders and risk managers were getting worried. 2 huge down days in 2 weeks. That wasn't normal. Even in corrections, you usually saw some bouncing. Up days mixed with down days. But this felt like momentum to the downside. Like gravity was taking over and the trading volume was growing. October 14th saw 207 million shares trade. That was the highest volume ever recorded at the NYSE. The systems were processing trades as fast as they could, but they were starting to lag. Orders were backing up. Execution times were slowing. The machines were straining. Portfolio insurance systems were starting to trigger more aggressively. The market had dropped about 10% from the August high. That was enough to set off the algorithms. Sell, protect the portfolio. The systems were generating sell orders for stock index futures, not millions of dollars, billions of dollars. And those sell orders were hitting the Chicago futures markets, pushing futures prices down, which created arbitrage opportunities, which triggered program trading, which pushed stock prices down, which triggered more portfolio insurance. The feedback loop was starting, but it was still manageable. There were still buyers, prices were falling, but not collapsing. Yet. Friday, October 16th, the market dropped another 108 points. The Dow closed at 2,246. That was 17% below the August high. Officially, a correction. A bear market is defined as a 20% drop. So technically, this was still just a correction. But it felt worse than a correction. The velocity was too fast. The volume was too high. The systems were acting weird. Veteran traders who'd been through corrections before said, "This feels different." And then there was the geopolitics. On Friday, October 16th, Iran attacked a US-flagged oil tanker in the Persian Gulf. This was part of the long-running Iran-Iraq war. The US had been escorting Kuwaiti oil tankers that were reflagged with American flags. The Iranians saw this as US intervention on Iraq's side, so they fired a silkworm missile at one of these tankers. The tanker didn't sink, but it was damaged. People were injured, and now the US was in a shooting war with Iran. Sort of. The Reagan administration retaliated by destroying 2 Iranian oil platforms in the Gulf, tit for tat. This made headlines. US and Iran clash in Gulf was the New York Times headline. Oil prices spiked. The risk of a broader Middle East war was suddenly very real, and that spooked investors. War is bad for stocks. Uncertainty is bad for stocks. So the Iran situation added another layer of worry on top of the market concerns and the interest rate concerns and everything else. Treasury Secretary James Baker had also made some comments on Thursday, October 15th, that worried markets. He suggested that if Germany didn't lower its interest rates, the US might not support the dollar anymore. This was diplomatic posturing. The US and Germany had been arguing about currency policy, but markets heard it as a threat. If the US stops supporting the dollar will collapse. If the dollar collapses, inflation will spike. If inflation spikes, the Fed will jack up interest rates. If interest rates go up, stocks will crash. So Baker's comments added fuel to the fire. By Friday evening, October 16th, when markets closed, traders were exhausted. It had been a brutal week. 3 big down days. The Dow had dropped 235 points in a single week. 9.5%. That was the worst week since the 1930s, but it was Friday evening, markets were closed. Time to go home. Time to rest. Time to forget about the chaos for 2 days. Some traders went to their weekend homes, the Hamptons, Connecticut, upstate New York. They tried to relax, play golf, spend time with their families, but many couldn't shake the feeling that something was very wrong. The selling had been too intense, the systems had been straining, the computers were behaving in ways they'd never behaved before. Selling that didn't make sense. Orders that were hard to execute, liquidity that seemed to be drying up. Michael, the bond trader at Salomon Brothers, went home to his loft in Tribeca on Friday night. His wife could see he was stressed. She asked what was wrong. He said, "I don't know. Something feels off." The market dropped hard today, hard all week. I've never seen anything like it. She asked, "Is your job in danger?" He laughed. "No, my job's fine. Salomon is solid. I'm fine. It's just, I don't know. I have a bad feeling. They ordered Chinese food and watched TV. I don't know." But Michael couldn't concentrate. He kept thinking about the order flow he'd seen that day, the volume, the intensity of the selling. Who was selling? Why? And more importantly, who was buying? Because in a market, for every seller, there's a buyer. That's how it works. But on Friday it felt like there were more sellers than buyers. A lot more. And if that continued, if Monday brought more selling, Michael didn't want to think about it. Saturday, October 17th, markets were closed globally. Some traders played golf, some slept in, some tried to spend quality time with their families. But the real market junkies, the ones who lived for this stuff, were reading the financial newspapers, the Wall Street Journal, the Financial Times, Barron's, looking for clues. What was happening? Why, the articles were cautious. Market faces test was one headline. Correction or crash was another. Most analysts quoted in the papers said it was just a correction. Markets go up and down. This is normal. Buy the dip. But a few voices were more ominous. One economist said, if the selling continues Monday, we could see a cascade effect. Portfolio insurance could trigger a self-reinforcing downward spiral. But that quote was buried in the middle of a long article. Most people didn't see it. Most people didn't understand what portfolio insurance was. And those who did thought the systems would work as advertised, protect portfolios, limit losses. The math was sound. What could go wrong? Sunday, October 18th, the day before Black Monday. For most Americans, it was a normal Sunday. Football, church, family dinners, relaxing. But in Hong Kong, it was Monday morning, and the Hong Kong Stock Exchange was about to open. Let's talk about time zones for a second, because they're critical to understanding how Black Monday unfolded. Global stock markets operate in sequence based on time zones. Hong Kong and Tokyo open first in the Asian trading session. Then Europe, London, Frankfurt, Paris, then New York. So what happens in Asia affects Europe. What happens in Europe affects New York. The world's financial markets are interconnected and information flows across them continuously. In 1987, this interconnection was still relatively new. Most trading was still domestic. American investors mostly bought American stocks, but institutional investors, the big pension funds and hedge funds, were starting to diversify globally, and arbitrageurs were starting to exploit price differences between markets. So when Hong Kong crashed, European traders paid attention. When Europe crashed, New York paid attention. The dominoes were lined up, and on Sunday night, October 18th, in New York time, the first domino was about to fall. It's 8 p.m. Sunday evening in New York. Most people are winding down their weekend, watching TV, getting ready for bed. Tomorrow is Monday, back to work, but in Hong Kong, it's 8 a.m. Monday morning. The opening bell at the Hong Kong Stock Exchange is about to ring, and a handful of traders in New York are staying up late to watch what happens. They've got wire services, Reuters terminals, Bloomberg terminals, still pretty new in 1987, showing real-time data from Hong Kong. They're watching, waiting, nervous. The Hong Kong market opens. Immediately, heavy selling. The Hang Seng Index, Hong Kong's main stock index, drops 3% in the first 10 minutes, then 5%, then 7%. It's a bloodbath. Hong Kong investors are panicking. They saw what happened in New York last week. They're scared. And they're selling. Everything. Stocks, futures, whatever they can dump. The prices are plummeting. Michael, the Salomon bond trader, is one of the few watching from New York. He couldn't sleep. He'd been tossing and turning, thinking about the market. So at 11 p.m. he got up, went to his home office, and turned on his Reuters terminal. He watched the Hong Kong open. His stomach dropped, down 5%, down 8%, down 10%. This is bad, he muttered to himself. This is really bad. By the time Hong Kong closed for the day, the Hang Seng had fallen 11.1%. $41 billion in market capitalization just gone. Evaporated. And Hong Kong traders knew exactly why it was happening. Portfolio insurance. The computer systems that were supposed to protect them were selling everything. Automatically. Relentlessly. And there were no buyers. Nobody wanted to catch a falling knife. So the systems kept selling, and prices kept falling, and the cycle fed on itself. But Hong Kong was just the beginning. At 1 a.m. New York time, London was about to open, and traders in London had seen what happened in Hong Kong. They were terrified. The London Stock Exchange opened at 8 a.m. London time. The FTSE 100, The UK's main stock index immediately gapped down 3%, down 5%, down 7%. Within an hour it was down 10%. Another massacre. Michael was still awake, watching. He called one of his colleagues. "Did you see Hong Kong?" "Yeah, I saw it." "Now London's getting killed. We need to get to the office." It was 2 a.m. Markets in New York didn't open until 9:30 a.m., but they knew they needed to prepare. "This is going to be the worst day in history," his colleague said. "Get some sleep. We're going to need it." Michael hung up. He didn't sleep. He just sat there, watching the screens, watching London collapse, thinking, how bad is this going to get? By 3 a.m., other traders were getting phone calls at home. Senior managers calling their teams. Get to the office. Now. By 5 a.m., the trading floors at Goldman Sachs, Salomon Brothers, Merrill Lynch, Morgan Stanley, Bear Stearns, all the major firms, were starting to fill up. It was still dark outside. The sun wouldn't rise for another hour and a half, but the lights were on. Computers were booting up. Screens were showing the carnage in Europe. Frankfurt down 8%. Paris down 9%. Milan down 10%. A tsunami of selling rolling across time zones, heading toward New York. By 6 a.m., the trading floors were fully staffed. Guys in suits walking in, grim-faced, coffee in hand, looking at the screens. The futures markets in Chicago had opened early for pre-market trading. S&P 500 futures were indicating a gap down at the open. Down 10%, down 12%, down 15%. The computers were showing sell orders stacking up. Billions of dollars worth of sell orders. Pension funds dumping stocks. Mutual funds liquidating positions. Insurance companies cutting exposure. Portfolio insurance systems executing automatic sell orders. And on the buy side, almost nothing. Almost nobody willing to step in and buy. The specialists at the New York Stock Exchange were arriving for work. These were the guys responsible for maintaining orderly markets. Their job was to match buy and sell orders for specific stocks. If there were more sellers than buyers, the specialist would buy stock themselves to balance the market. If there were more buyers than sellers, they'd sell. They were the shock absorbers, the stability mechanisms. But on this Monday morning, the specialists were looking at their screens in horror. Sell orders for millions of shares. Buy orders for thousands. 100 to 1 imbalances. 200 to 1 imbalances. How do you make a market with those numbers? You can't. At 7 a.m. the sun started to rise over Manhattan. It was going to be a beautiful day. October in New York. Cool temperatures. Clear skies. The kind of day you'd want to be outside. But nobody on Wall Street was thinking about that. They were preparing for war. Financial war. By 8 a.m. the senior executives at the major firms were holding emergency meetings. Risk managers presenting worst-case scenarios. What if the Dow drops 10%? We lose X billion. What if it drops 15%? What if it drops 20%? The models didn't even go to 20%. Nobody thought a 20% drop in one day was possible. That would be unprecedented. That would be worse than any single day in the Great Depression. Impossible, right? The NYSE chairman, John Phelan, was meeting with his staff. Some were arguing to delay the opening, give people time to calm down, let the systems catch up on the order backlog. Others said, we can't delay. That would cause panic. We're the New York Stock Exchange. We don't close because people are scared. Phelan made the call. We open at 9:30 a.m. as scheduled. We'll handle it. At 9 a.m. the floor of the New York Stock Exchange was packed. Over 2,000 people. Traders in their coloured jackets, specialists at their posts, runners ready to carry paper slips, clerks at computer terminals, managers overseeing everything, security guards, media with cameras. Everyone was there. The energy was like electricity, crackling, dangerous. Everyone knew something historic was about to happen. The screens showed the futures still plummeting, down 18%, down 20%. If the stock market opened anywhere near where futures were trading, it would be catastrophic. Pension funds would be destroyed. Retirement accounts would be decimated. The financial system itself could be at risk. At 9:15 a.m., some of the specialists reported that they couldn't open their stocks. The sell orders were too large. They needed more time to find buyers. But the exchange had a rule. Stocks must open by 9:30 or as soon as possible afterward. The market waits for no one. At 9:25 a.m., 5 minutes before the opening bell, the noise on the trading floor was building. Traders shouting into phones, specialists yelling at each other across the floor, runners getting ready to sprint. The tension was physical. You could feel it in the air. At 9:29 a.m., 1 minute to go, the floor went dead silent. 2,000 people, and you could hear a pin drop. Every eye was on the clock. Every ear was waiting for the bell. At exactly 9:30 a.m., the opening bell rang, a loud, clear sound that echoed across the floor, and then all hell broke loose. The opening bell rings at 9:30 a.m., and immediately chaos. The Dow Jones futures had been indicating a massive gap down. Everyone knew the open would be bad, but nobody was prepared for this. The first stocks to open are the big liquid names: IBM, General Electric, AT&T. But they don't open at 9:30. They can't. The specialists responsible for these stocks are looking at order imbalances that make no sense. Sell orders for millions of shares, buy orders for thousands. The computers are calculating opening prices, but the numbers are insane. IBM should open down $15 per share, that's 12%, in 1 second, before any trading even happens. The specialist for IBM delays the opening. He needs more time. He's frantically calling around trying to find buyers. Any buyers? He calls Goldman Sachs. Can you take 100,000 shares? Goldman says no. Too risky. He calls Morgan Stanley. Can you take 50,000? Morgan says maybe, but at what price? The specialist doesn't know. The market is moving too fast. By the time they agree on a price, it will be outdated. Michael, the bond trader at Salomon Brothers, is sitting at his desk watching his screens. His job isn't stocks. He trades bonds. But everyone's watching stocks today. The main screen shows the Dow Jones Index. It's frozen at yesterday's close, 2,246.74. Waiting, waiting, waiting for stocks to open. The clock shows 9:31, then 9:32, then 9:33. Some stocks still haven't opened. This is unprecedented. On a normal day, most stocks open within 60 seconds of the bell. Today, 3 minutes in, and major stocks are still dark. Not trading, frozen. The futures markets in Chicago are in freefall. S&P 500 futures are down 20%. That means if the stock market opens in line with futures, the S&P 500 will drop 20% at the open. The Dow will drop 450 points in 1 second, just from the opening gap, before anyone even has a chance to trade. It would be the single largest point drop in history, and the market hasn't even started trading yet. At 9:34 a.m., the first major stocks finally open. IBM opens at $104, down from $116 the previous day. That's a 10% drop at the open. General Electric opens down 8%. DuPont down 9%. The numbers are flashing on the screens, and traders are staring in disbelief. These are blue chip companies, the safest stocks in America, and they're collapsing. But here's the thing, even at these prices, there are no buyers. The specialists open the stocks, execute the orders that were queued up overnight, and then nothing. No follow-up buying. Just more selling. The portfolio insurance systems are automatically generating more sell orders. The computers see that stocks have dropped 10%, and they calculate, we need to sell more to protect the portfolio. So they sell, and prices drop further, and the computers sell more. It's the death spiral, the feedback loop that nobody thought would happen, but it's happening. Jennifer, the junior trader at her mid-sized brokerage, is on the phone with a client. The client is a pension fund manager. He's screaming, not yelling, screaming, I need you to sell everything. Sell it all. Now. Jennifer is trying to explain, Sir, the market just opened. There are no buyers. If I sell now, you'll get terrible prices. The client doesn't care. I don't care about prices. Just get me out. Jennifer puts him on hold. She looks at her screen. The sell orders are stacking up. Not just from this one client, from dozens of clients. Everyone wants out. Everyone wants to sell. And she knows what that means. If everyone's selling and nobody's buying, prices are going to collapse. We're in trouble, she mutters to her colleague at the next desk. We're in real trouble. By 9:45 a.m., 15 minutes into trading, the Dow has dropped 150 points. That's 6.7% in 15 minutes. And it's accelerating. The selling is intensifying. More portfolio insurance systems are triggering. More panic is spreading. The phone lines are overloaded. Every broker in America is getting calls from clients asking the same question. What's happening? Should I sell? The brokers don't know what to say. This has never happened before. The scripts they usually use, it's just a correction, stay calm, think long term. Those scripts feel ridiculous today. This isn't a correction, this is a crash. The New York Stock Exchange computer systems are starting to strain. In 1987, the technology is advanced for its time, but it's not built for this. The systems can handle 200 million shares per day comfortably. Maybe 250 million if pushed. But today, the volume is already at 100 million shares in the first 15 minutes. At this rate, they'll hit 400 million shares by the closing bell. Maybe 500 million. The computers are processing trades as fast as they can, but they're falling behind. A trade executed at 9:50 a.m. might not be confirmed until 10:30 a.m. That 40-minute lag is terrifying. Traders don't know if their orders went through. Clients don't know if they're in or out of positions. It's chaos. By 10 a.m., the Dow is down 200 points, 8.9%, in 30 minutes. The trajectory is clear. This is going to be the worst day in market history. The talking heads on CNBC, which just launched as a full-time financial news network earlier this year, are struggling to describe what they're seeing. One analyst says, this is panic, pure panic. There's no other word for it. Another says, the portfolio insurance systems are malfunctioning. They're supposed to protect portfolios, but they're causing the crash. But it's too late for analysis. The crash is happening in real time. The specialists on the NYSE floor are overwhelmed. Their job is to maintain orderly markets, match buyers and sellers, step in with their own capital if necessary to smooth out imbalances. But the imbalances today are too large. The specialist for a major pharmaceutical company sees sell orders for 500,000 shares and buy orders for 20,000 shares. A 25-to-1 imbalance. He's supposed to buy the remaining 480,000 shares himself to balance the market. But that's $15 million. He doesn't have $15 million. His firm might, but not him personally. And even if he did, why would he buy in a crashing market? He'd lose everything. So he does what he's not supposed to do. He lets the stock gap down. He opens it at a price so low that some buyers finally appear. The stock drops 15% in one trade. The system is breaking. At 10:30 a.m, something strange starts happening. Some stocks stop trading altogether. Not because the exchange halted them, they just stop. No buyers, no sellers. The screens show no quote available. The specialists literally cannot make a market. There's no price where supply equals demand. It's binary. Either nobody wants to sell or nobody wants to buy. And when nobody wants to buy, what's the stock worth? Zero? The theoretical answer is yes. But that can't be right. These are real companies with real assets and real cash flows. But in this moment, the market is saying, I don't know what this is worth, so I'm not trading it. Michael looks at his screens and sees dozens of stocks with no quotes. Frozen. He's never seen this before. He turns to his boss, who's standing nearby, watching. What do we do? His boss shakes his head. I don't know. We wait. We see how bad it gets. Michael asks, how bad can it get? His boss doesn't answer. Because the answer is terrifying. It can get as bad as everyone's fear. And right now, everyone is terrified. By 11 a.m, the Dow is down 250 points. 11.1%. The selling is relentless. Wave after wave. Every time it looks like the market might stabilize, another wave of selling hits. The portfolio insurance computers don't get tired. They don't feel fear. They just execute their programs. Sell, protect, sell more. The algorithms were designed to limit losses, but they're creating losses. Every sale pushes prices lower. Every lower price triggers more selling. It's a loop, a vicious, unstoppable loop. The human stories are heartbreaking. Robert, the 59-year-old dentist in California, is at work. He's got a patient in the chair, but he can't concentrate. He excuses himself, goes to his office, and calls his financial advisor. The advisor's line is busy. He tries again. Busy. He tries a third time. Finally, it rings through. The advisor sounds frazzled. Robert, I was going to call you. Your 401k is down about 10% today. I recommend holding. This will pass. Robert asks, how much is 10%? The advisor pauses. You're down about $55,000 today. Robert feels sick. $55,000? In 3 hours? The advisor says, I know it's scary, but if you sell now, you lock in the losses. The market will recover. It always does. Robert hangs up. He doesn't know what to do. He goes back to his patient. His hands are shaking. He's supposed to be drilling a cavity. He can't do it. He tells his patient there's an emergency, reschedules the appointment, and goes home. He can't work. Not today. David, the pension fund manager in California with the portfolio insurance system, is watching his screens in horror. His system has been selling futures all morning, automatically, protecting the portfolio. Except the portfolio isn't protected. It's down 12%. The futures sales were supposed to offset the stock losses, but the futures are falling faster than the stocks. The basis, the price difference between futures and stocks, has blown out. The arbitrage that's supposed to keep them aligned isn't working. There aren't enough arbitrageurs. There isn't enough capital. The system is broken. David calls the company that sold him the portfolio insurance. He gets through to a technical support person. The system isn't working. We're down 12%. The support person says the system is working exactly as programmed. It's selling futures to protect you. David yells into the phone, but we are not protected. We are losing money. The support person doesn't know what to say. The system is doing what it's supposed to do. The problem is that everyone's system is doing the same thing at the same time, and the market can't absorb it. By 11:30 a.m, rumours start spreading. Rumours that major firms are in trouble. Rumours that some banks might fail. Rumours that the exchange might close early. None of these rumours are true. Yet. But in a panic, rumours become reality. If enough people believe a bank is failing, they'll pull their money out, and the bank will fail. Self-fulfilling prophecy. So the firms have to issue statements. We're fine. We're well capitalised. We're not in trouble. But the statements sound desperate, and desperation breeds more fear. The Federal Reserve in Washington is watching. Alan Greenspan, who became Fed chairman just 2 months ago in August, is in Dallas giving a speech. He's supposed to fly back to Washington later today, but his staff calls him. You need to come back now. We might have a crisis. Greenspan cuts his speech short and heads to the airport. On the plane, he's reading wire reports about the market. Down 250 points. Down 300 points. He knows what this means. If the market crashes too hard, it could trigger a recession. Or worse. Financial system collapse, bank runs, depression. His job is to prevent that. But he's on a plane. He can't do anything until he lands. By noon, the Dow is down 300 points. 13.4%. This is now officially the worst day since 1929. Worse than Black Thursday, October 24th, 1929. Worse than Black Tuesday, October 29th, 1929. This is Black Monday, 1987, and it's earning its name. The NYSE floor is in chaos. Traders are shouting, some are crying, some are laughing hysterically, a stress response when your brain can't process what's happening. One trader collapses. Heart attack. Paramedics carry him off the floor. Trading continues. It doesn't stop for medical emergencies. The sell orders keep coming. Pension funds are dumping positions. Mutual funds are liquidating. Insurance companies are cutting exposure. And retail investors, the ordinary people like Robert, are calling their brokers in a panic. Get me out. Sell everything. I don't care about the price. Just get me out. Sell everything. The brokers are executing the orders, but the execution prices are brutal. If you wanted to sell IBM at noon, you might get $15 per share, less than where it was trading 15 minutes ago. That's a 15% haircut just from the bid-ask spread. The market isn't functioning, it's breaking. Michael is eating lunch at his desk, a sandwich from the deli downstairs, but he's not tasting it. He's just eating mechanically, staring at his screens. His bond positions are actually up today. When stocks crash, money usually flows into bonds. Flight to safety. So his portfolio is making money. He should be happy. But he's not. He's watching the stock market disintegrate, and he knows this isn't over. If stocks crash this hard, the economy will follow. Recession. Maybe depression. And then bonds will suffer too. Everything's connected. You can't escape. Jennifer, the junior trader, is exhausted. She's been on the phone non-stop for 3 hours. Client after client screaming at her, some blaming her personally. Why didn't you tell me to sell last week? Why didn't you warn me? She wants to scream back, I didn't know. Nobody knew. But she doesn't. She stays professional. She executes the orders. She watches her commission account grow. She makes money on every trade, whether it's a buy or a sell. But she feels sick. She's making money while her clients are losing their life savings. It doesn't feel right. By 1 p.m. the Dow is down 350 points, 15.6%. We're in uncharted territory. The NYSE officials are having emergency meetings. Should we halt trading? Close the exchange early? The argument for closing: we need to stop the panic. Give people time to think, let the systems catch up. The argument against closing would signal total disaster. It would say the system can't handle this. It would destroy confidence completely. They decide to stay open, keep trading. We'll make it to 4 p.m. But the specialists are running out of capital. Remember, specialists are supposed to buy when everyone else is selling. They're supposed to be the buyers of last resort. But they're not billionaires. They're running firms with $50 million or $100 million in capital, and they've already bought millions of shares to try to stabilize their stocks. They're underwater on those positions. If they buy more, they'll bankrupt themselves. So they stop buying. They widen the spreads. The bid-ask spreads, the difference between the price you can buy and the price you can sell, blow out to 5%, 10%, sometimes 20%. In a normal market, the spread on a liquid stock is 0.1%. Today it's 10%. The market has completely broken down. The Chicago Mercantile Exchange, where stock index futures trade, is in even worse shape. The futures are supposed to track the stocks. But today, futures are trading at a massive discount to stocks. S&P 500 futures are 20 points below fair value. That means futures traders are panicking harder than stock traders. The computers are selling futures faster than arbitrageurs can buy them. The arbitrageurs who are supposed to keep futures and stocks aligned are overwhelmed, or they're out of capital, or they're too scared to trade. So the basis blows out. And that creates another problem. When futures fall below stocks, program traders are supposed to buy futures and sell stocks, which pushes stock prices down, which makes everything worse. At 2 p.m. the Dow is down 400 points, 17.8%. 400 points. That's more than the entire Dow was worth in 1980, gone, in 5 hours, vaporized. The wealth destruction is incomprehensible. The market capitalization of all US stocks has fallen by $500 billion. That's more than the entire federal budget. That's more than the GDP of most countries. Just gone. Where did it go? Nowhere. It didn't go anywhere. It never existed. It was just numbers on screens. Collective belief. And when everyone stops believing at the same time, the numbers fall. Some traders have given up. They're just sitting at their desks, staring. What's the point? You can't fight this. The selling is too strong. The systems are too broken. Michael's boss walks by and sees him sitting motionless. You okay? Michael shrugs. I don't know. This is insane. We're watching the financial system collapse in real time. His boss sits down next to him. I know. I've never seen anything like this. I was here in 73, 74. Those were bad years. But this is different. This is faster. This is more violent. Michael asks, what do we do? His boss says, we survive. That's all we can do. Survive the day. Figure out tomorrow. Jennifer gets a call from one of her biggest clients, an older man, a retiree. He's been a client for 15 years. He's always been calm, rational, patient. But today, his voice is shaking. Jennifer, I need to sell everything. Everything. She tries to talk him down. Sir, you're 73 years old. You're retired. You don't need this money for 20 years. You can ride this out. He says, I know what you're going to say, but I can't. I can't watch this anymore. I need to sell. Please, just sell it all. Jennifer executes the order. She watches his portfolio, built over 30 years, Liquidate in 10 minutes. He loses 18% on the execution. The market is falling so fast that by the time his orders get filled, prices are even lower than when he called. He'll never recover from this. He'll die before the market gets back to where it was. Jennifer hangs up the phone and starts crying. She goes to the bathroom so nobody sees her. At 2:30 p.m, something unexpected happens. A small rally, a bounce. The Dow goes from down 420 points to down 390 points. Is this it? Is this the bottom? Traders perk up. Maybe the panic is over. Maybe we've hit maximum fear and now buyers are coming in. Some brave souls start buying. Bargain hunters. Value investors. Warren Buffett types who see blood in the streets and start buying. The market rallies another 20 points. Down 370 now. Okay, we're stabilising. We're going to be okay. But it's a fake out. A dead cat bounce. At 2:45 p.m, the selling resumes. More portfolio insurance systems trigger. More margin calls go out. When your portfolio drops too much, your broker demands you deposit more cash or they'll sell your positions. More forced selling. The rally evaporates. Down 400, down 420, down 450. The selling is even heavier than before. It's like the market needed a breather before it could fall further. Now it's falling again. Harder. By 3 p.m, 1 hour until the closing bell, the Dow is down 460 points, 20.5%. We've crossed into bear market territory. A 20% decline from the peak is the official definition of a bear market. But this isn't a bear market. Bear markets take months to develop. This is a crash, a one-day wipeout. And it's not over. The specialists are shell-shocked. Some have literally stopped trying to make markets. They're just watching. They've given up. They can't buy anymore. They're tapped out. The system that's supposed to provide liquidity when everyone else is panicking has broken down. The specialists are panicking too. The NYSE officials are back in their emergency meeting. Should we extend trading hours? Give people more time to close positions? Or should we close early? Cut our losses? They decide we close at 4 p.m. as scheduled, no exceptions. 1 more hour, we can make it 1 more hour. Robert, the dentist, is at home, watching CNBC. His wife is next to him. They're both staring at the TV. The Dow is down 460 points. His 401k has lost $110,000 today. More than $100,000. Gone. His wife asks, "What does this mean for us?" Robert says, "It means we're not retiring at 65. Maybe not at 70. Maybe not ever." She starts crying. They've worked their entire lives, saved carefully, done everything right, and in one day it's gone. Not all of it, but enough to ruin their plans, enough to steal their dreams. David, the pension fund manager, is doing math. His $2 billion portfolio is down 22%. That's $440 million. Nearly $500 million. Lost. In one day, his portfolio insurance was supposed to protect him. It was supposed to limit losses to 10%. But it didn't work. The system failed. The models were wrong. The assumptions were false. And now he has to explain to his board how he lost $440 million in 6 hours. He doesn't know what he's going to say. I'm sorry? The computers did it. Nobody could have seen this coming. None of those excuses will work. He's probably going to be fired, maybe sued. His career is over. At 3:30 p.m, 30 minutes to close, the Dow is down 480 points. 21.4%. The selling won't stop. It's like gravity. Relentless. Unstoppable. Traders are just going through the motions now, executing orders, filling tickets. There's no strategy anymore. There's no analysis. just survival. Make it to 4 p.m. The computers are badly behind. Trades executed at 2 p.m. still haven't been confirmed. The systems are processing as fast as they can, but they're designed for 200 million shares per day. Today's volume is going to hit 600 million, 3 times normal. The computers can't keep up. Traders don't know their positions. Clients don't know if their orders executed. It's blind. Everyone's flying blind. At 3:45 p.m., 15 minutes to close, the Dow is down 500 points. 22.3%. 500 points. The number is so large it's hard to process. That's a 22% loss in one day. For comparison, the biggest single-day percentage decline in the Great Crash of 1929 was 12.8%. Today's crash is nearly twice as bad. And we're not in a depression. The economy is fine, corporate earnings are fine. There's no war, there's no scandal, there's no reason for this. Except computers. Computers programmed to sell are selling to other computers programmed to sell. And the result is financial carnage. Michael looks at the clock. 3:50 p.m. 10 minutes. He's made it this far. He can make it 10 more minutes. His positions are actually okay. Bonds are up. He'll have a good day, at least on paper. But he feels hollow. He's watching something historic and terrible. He's watching the financial system break in real time. And he knows this isn't really over. Tonight, firms will calculate their losses, banks will calculate their exposures, clearinghouses will calculate whether everyone can settle their trades. And if the numbers don't work, if someone can't pay, the whole system could collapse tomorrow. This might just be day one of a multi-day crash. We might be headed for another Great Depression. Michael doesn't want to think about it. But he can't stop thinking about it. Jennifer is off the phone finally. No more calls coming in. It's 3:55 p.m., 5 minutes to close. She looks at her trade log for the day. She executed 287 trades, more than she's ever done in a single day. The commissions add up to $18,000. That's her revenue for the day. In a month, that will translate to maybe $3,000 in bonus. She should be happy, but she's not. She's disgusted. She made money while her clients lost fortunes. The system is rigged. She knows it now. It's always been rigged. But today, the rigging was obvious. At 4 p.m., the closing bell rings. A loud, clear sound. But nobody's celebrating. The Dow Jones Industrial Average closes at 1,738.74, down 508 points, down 22.6%, the largest single-day percentage decline in stock market history. $500 billion in market value erased. $500 billion. Gone. The trading floor goes quiet. 2,000 people, and you can hear a pin drop. Some traders collapse into their chairs, physically and mentally exhausted. Some cry, some laugh. That hysterical stress laugh. Some just stare at the screens, unable to process what just happened. Some walk off the floor without a word. One trader will later describe the moment. It felt like we'd just survived a war. But we didn't know if the war was over, or if this was just the first battle. The specialists start tallying their losses. Many of them are wiped out. They bought millions of shares trying to stabilize the market. Those shares are now worth 20% less than what they paid. They're bankrupt. Some of the specialist firms won't survive the week. They'll have to be bailed out or merged into larger firms. The system that was supposed to be the bedrock of the NYSE, the specialists providing liquidity, has failed. The computer systems at the NYSE are still processing trades. It's 5 p.m. The market closed an hour ago. but there are tens of thousands of trades that still haven't been confirmed. It will take all night, maybe into Tuesday morning. Traders won't know their final positions until tomorrow. Clients won't know their account balances until tomorrow. It's chaos. Organised chaos, but chaos nonetheless. Michael leaves the office at 6 p.m. He walks out into the cool October evening. The sun has set. The city looks normal. People walking to dinner, cabs honking, life going on. Nobody out here knows what just happened. Nobody out here understands that the financial system nearly broke today. He walks home. His wife is there. She's made dinner. He can't eat. He just sits on the couch, staring at nothing. She asks, "Are you okay?" He says, "I don't know. I really don't know." Jennifer gets home at 8 p.m. She's been at the office for 13 hours. She opens a bottle of wine and drinks half of it in 20 minutes. She's never been a big drinker, but tonight she needs it. She needs to forget. She needs to not think about the retiree who lost his life savings. She needs to not think about the look on her colleague's face when he realized his own 401k had been decimated. She needs to not think about tomorrow, because tomorrow might be worse. Robert is still watching CNBC at 9 p.m. The evening news is covering the crash. The anchors are grave, serious, using words like catastrophe and crisis and disaster. Experts are being interviewed. Some say this is like 1929. Others say it's worse. One says, if the Fed doesn't act, we could be in a depression by next year. Robert turns off the TV. He can't watch anymore. He goes to bed. He doesn't sleep. He just lies there, staring at the ceiling, thinking about his retirement that will never happen. David is in his office at 10 p.m. He's writing a memo to his board explaining what happened. He's trying to find words that don't sound like excuses. The portfolio insurance system malfunctioned. The assumptions in the model were incorrect. The level of coordinated selling exceeded all historical precedents. It all sounds like bullshit, because it is bullshit. He screwed up. He trusted a computer system that was flawed. He put $2 billion into a strategy that failed spectacularly. He's going to be fired. He knows it. He saves the memo and emails it to the board. Then he sits in the dark, alone in his office, and wonders what he's going to do next. But the real crisis is just beginning. The market has closed. Trading has stopped. But the financial system operates 24/7. Banks are calculating their exposures. Clearinghouses are calculating whether everyone can settle their trades. The Fed is preparing for emergency action. And in Asia, markets are about to open for Tuesday trading. Hong Kong, Tokyo, Singapore. They're all watching what happened in New York. And they're terrified. At the Federal Reserve Building in Washington, Alan Greenspan has finally arrived back from Dallas. It's 10:30 p.m. He goes straight into an emergency meeting with his senior staff. They brief him on the situation. The Dow dropped 22.6%. The worst day in history. But that's not the scary part. The scary part is the clearing system. Let me explain how clearing works, because it's about to become the most important thing in the world. When you buy a stock, you don't immediately get the stock. And when you sell, the buyer doesn't immediately pay you. There's a settlement process. It takes 3 days. In the meantime, a clearinghouse acts as the middleman. They guarantee both sides of the trade. But to guarantee trades, they need collateral. They require all participants to post margin. Cash or securities that can be seized if someone fails to settle. On a normal day, the margin requirements are manageable. A few $100 million across all firms. But on Black Monday, with $500 billion in trades, the margin requirements have exploded. Some firms are facing margin calls of $500 million each. and they have to post that cash by tomorrow morning, or they default. Greenspan asks, "How bad is it?" His staff shows him the numbers. Major Wall Street firms are facing margin calls totaling $3 billion. That's cash they need to produce by 10 a.m. Tuesday. Some of them have it. Goldman Sachs has it. Morgan Stanley has it. But some smaller firms don't. And here's the terrifying part. If one major firm defaults on its margin call, the clearinghouse could collapse. And if the clearinghouse collapses, all trading stops. Stocks, bonds, futures, options, everything. The entire financial system freezes. When that happens, banks stop lending. Companies can't access credit. Payrolls don't get met. The economy seizes up. Depression. Greenspan looks at his senior staff. We have to prevent this. How? The answer, the Fed needs to signal that it will provide unlimited liquidity. We need to tell the banks to lend to the securities firms, and we need to tell the banks that if they need cash, we'll lend it to them. Unlimited, no questions asked, just keep the system functioning. But there's a problem. The Fed can't just give money away. It's not authorized to lend directly to securities firms. Only to banks, so the strategy has to be indirect. The Fed will lend to banks. The banks will lend to securities firms. It's a daisy chain. But it should work. If everyone cooperates. Greenspan picks up the phone. It's 11 p.m. He starts calling bank CEOs. These are the most powerful people in finance, the heads of Chase Manhattan, Bank of America, Citibank, JP Morgan, Chemical Bank. One by one, Greenspan delivers the same message. This is Alan Greenspan. I'm calling because the financial system is at risk of collapse. Tomorrow morning, securities firms will need to borrow billions of dollars to meet margin calls. I need you to lend to them. I don't care about credit risk. I don't care about collateral. If they need money, give it to them. And if you need liquidity, the Fed will provide it. We'll discount any paper you bring us. Government bonds, corporate bonds, mortgages, whatever. We'll give you cash for it. But you have to lend tomorrow. Do you understand? The bank CEOs understand. Some are shocked that the situation is this dire. Others already knew. One CEO asks, "What if the firms can't pay us back?" Greenspan's answer, "Then we'll all have bigger problems than one bad loan. Just lend." The CEO agrees. They all agree. What choice do they have? The chairman of the Federal Reserve is telling them the financial system is at stake. You don't say no to that. By midnight, Greenspan has made a dozen calls. The banks are on board. They'll lend. Now he needs to draft a public statement. Something to calm markets. Something to signal. The Fed is here. We're not going to let the system collapse. His staff works on the language. It needs to be strong but not panicky, reassuring but not overconfident. By 2 a.m. they have it. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirms today its readiness to serve as a source of liquidity to support the economic and financial system. 36 words. But those 36 words will save the financial system. They'll release it before the market opens Tuesday. But even as they're drafting the statement, the crisis is unfolding in real time. In Tokyo, where it's already Tuesday afternoon, the Nikkei stock index has collapsed 14.9%. The worst day in Japanese stock market history. Japanese investors are panicking. Pension funds are selling. The Bank of Japan is trying to intervene, but the selling is overwhelming. The crash is global now. It's not just America, it's everywhere. At 3 a.m. New York time, Hong Kong reopens for Tuesday trading. The Hang Seng had closed Monday, down 11%. Now it's Tuesday morning in Hong Kong, and the question is, will the selling continue? The market opens. Heavy selling immediately. Down 5% in the first minute. Down 8%. Down 10%. Hong Kong traders are looking at what happened in New York. They're looking at Tokyo's 15% drop. And they're terrified. The computers are selling again. Portfolio insurance systems triggered. Program trading accelerating the decline. It's Monday all over again. Michael, the Salomon bond trader, is at home. He should be sleeping. He's been up for 20 hours, but he can't sleep. He's watching Hong Kong on his Reuters terminal at home. Down 10%. This is bad. If Hong Kong crashes again, London will crash again. And if London crashes again, New York might crash again on Tuesday. We could have 3 straight days of 10% plus drops. That would be a 30% decline in 3 days. The Dow would be at 1,500. That's back to 1985 levels. 2 years of gains wiped out. And if that happens, the economy will follow. Recession. Maybe depression. Michael pours himself a scotch. He never drinks at 3 a.m, but tonight is not a normal night. At 4 a.m. New York time, London is preparing to open. European traders have been watching Hong Kong and Tokyo disintegrate. They're expecting the worst. The FTSE had dropped 10% on Monday. What will Tuesday bring? The FTSE opens at 8 a.m. London time. Immediate selling, down 3%, down 5%. But then something changes. The Bank of England issues a statement. The bank stands ready to provide liquidity to the market. It's similar to the Fed's approach. We'll lend, we'll support the system, don't panic. And it works. Sort of. The selling slows, the FTSE stabilises around down 5%. Still bad, but not catastrophic, not accelerating. The Bank of England's intervention is having an effect. At the same time, the European central banks are coordinating. Germany's Bundesbank, France's Banque de France, Switzerland's Swiss National Bank. They're all issuing similar statements. We'll provide liquidity. We'll support our financial systems. The global central banks are acting in concert. It's unprecedented. They're all doing the same thing at the same time. Because they all understand if one major financial centre collapses, the contagion will spread to everyone. This is a global crisis now. It requires a global response. At 6 a.m. Tuesday, New York traders are arriving at their offices. They're exhausted. Many didn't sleep. They're looking at the screens. Asia down, Europe down. Futures indicating New York will open down another 10%. If that happens, the Dow will be down 30% in 2 days. Unprecedented, catastrophic. But they also see the Fed's statement. The Fed is ready to provide liquidity. The banks have been told to lend. There's a floor under the market now. Maybe. At 7 a.m, the major Wall Street firms hold emergency meetings. They need to calculate. Can we survive? Do we have enough capital? Can we post the margin calls? Goldman Sachs runs the numbers. They're okay. Barely. Morgan Stanley runs the numbers. They're okay. Salomon Brothers? Okay. Merrill Lynch? Okay. But some smaller firms are in trouble. They don't have the capital. They can't post margin. They call the big banks begging for loans. The banks following the Fed's orders lend. Unprecedented loans. $500 million here. $300 million there. Just enough to keep the firms alive for another day. At 8 a.m, there's a conference call between the NYSE, the SEC, the Fed, and the major Wall Street firms. The question, do we open at 9:30? Or do we delay? Or do we close? The argument for delaying, the systems are still backed up. Trades from Monday haven't settled. We need time. The argument for opening, if we don't open, it will cause even more panic. We have to show the system still works. They decide, We open at 9:30 as scheduled, but we're activating circuit breakers. If the market drops too much too fast, we'll halt trading temporarily. Give people time to think. It's a new rule, improvised overnight, but it might save us. At 9:30 a.m. Tuesday, October 20th, the market opens, and the selling starts immediately. The Dow gaps down 100 points at the open. Traders brace for another crash. Here we go again. But then something different happens. Buyers appear. Real buyers. Not computer sellers. Not portfolio insurance algorithms. Real humans making real decisions to buy stocks. Some are bargain hunters who think prices have fallen too far. Some are contrarians who believe in buying when everyone else is panicking. Some are value investors following Warren Buffett's famous advice: be greedy when others are fearful. Some are just brave, or stupid. Hard to tell the difference. The buying slows the decline. The Dow is down 50 points, then down 100, then back to down 50. It's bouncing around, volatile. But it's not collapsing. The selling pressure is still there. Portfolio insurance systems are still generating sell orders, but there are buyers now, enough buyers to absorb some of the selling. The balance has shifted, just slightly, but enough. Michael is at his desk watching the screens. He got maybe 2 hours of sleep. His eyes are burning, his head is pounding, but he's watching. Is this it? Is the worst over? The Dow goes positive at 10:15 a.m., up 10 points from Monday's close, then up 20, then up 30. A rally. A real rally. Not a fake out like yesterday at 2:30. This feels different. The volume is huge. Everyone's trading. But the buyers are winning. The volume is huge. For the first time in 2 days, the buyers are winning. By 10:30 a.m., the Dow is up 50 points. The media is calling it a turnaround. The Fed's intervention worked. The central banks saved the markets. Liquidity is flowing. The banks are lending to the securities firms. The margin calls are being met. The clearinghouses aren't going to fail. The system is holding. By 11 a.m., the Dow is up 100 points. A 5.7% rally. It's the biggest point gain in history. Bigger than any single day in the bull market. The pendulum is swinging the other way now. Fear is turning to relief. Panic is turning to hope. Jennifer is at her desk, taking calls. But the tone of the calls has changed. Yesterday, clients were screaming, "Sell everything. Get me out." Today, they're cautious. Should I buy? Are we at the bottom? She's giving the same advice she always gives. I can't predict the market. Nobody can. But if you're buying for the long term, these prices are attractive. She doesn't know if that's true, but it's what she's supposed to say. And some clients are buying. Not a lot, but some. Testing the waters, dipping their toes back in. By noon Tuesday, the Dow is up 150 points, 8.6%. The media has shifted from crisis coverage to recovery coverage. The worst is over. The Fed saved us. Greenspan is a hero. The system worked. But traders know the truth. Tuesday's rally doesn't erase Monday's losses. The Dow is still down 15% from Friday. $300 billion in wealth is still gone. Retirements are still destroyed. Pensions are still decimated. Robert, the dentist, still lost $110,000. David, the pension fund manager, still lost $440 million. Jennifer's retiree client, who sold at the bottom on Monday, he's still out 18%. Those losses are permanent. Tuesday's rally just means we're not going to have another Great Depression. It means the system survived. That's all. It's not a victory, it's just survival. But survival is enough. By 2 p.m. Tuesday, the rally is starting to fade. It's enough. Some of the early buyers are taking profits. Some skeptics are selling into the rally. The Dow peaks at up 180 points, then pulls back to up 120. It's normal market behaviour, healthy even. The panic is over, but the fear remains. What if Wednesday brings more selling? What if this is just a dead cat bounce before another leg down? Nobody knows. They're trading minute to minute, day to day. Long-term planning is impossible right now. At 3 p.m. Tuesday, 1 hour before the close, the Dow is up 100 points, a solid 5.7% gain. Not as dramatic as the intraday high, but still impressive. The NYSE officials are relieved. They made it through 2 days. The system didn't collapse. The clearinghouses didn't fail. Tuesday's trading volume is actually higher than Monday's. Over 600 million shares. The computers are still straining, but they're processing. Trades are being confirmed. The backlog from Monday is slowly clearing. By Wednesday they'll be caught up. Maybe. By 4 p.m. Tuesday the closing bell rings. The Dow closes up 102 points. 5.9%. A huge rally. But everyone's exhausted. The 2-day whipsaw, down 22%, then up 6%, has been emotionally devastating. Traders are numb. They're relieved it's over, but they're also scared, because nobody knows if it's really over. What if Wednesday brings more selling? What if the portfolio insurance systems start selling again? What if foreign investors pull out of US markets? Nobody knows. All they know is, we survived Tuesday. Tomorrow is another day. So the market survived. Tuesday's rally proved the system wouldn't collapse completely. But the damage was done. $500 billion in wealth vanished on Black Monday. That's $1.3 trillion in today's dollars adjusted for inflation. To put that in perspective, that's more than the entire GDP of Canada. Gone in 6 hours. The question everyone was asking, who lost, who won, and most importantly, why did this happen? Let's start with the losers, because there were a lot of losers. The most obvious losers were retail investors, ordinary people. The dentists and teachers and plumbers who'd put their life savings into the stock market during the bull run. People like Robert, the 59-year-old dentist we talked about earlier. He lost $110,000 on Black Monday. His 401k went from $550,000 to $440,000. His plans to retire at 65 were destroyed. He'd have to work until 70, maybe 72. His golden years, the reward for 40 years of hard work, had been stolen by a computer algorithm he didn't understand. Robert wasn't unique. Millions of Americans had similar stories. A 52-year-old factory worker in Michigan lost his entire retirement in 1 day. He'd been planning to retire early. Now he'd work until he physically couldn't anymore. A 45-year-old nurse in Texas saw her savings account drop 25%. She'd been saving for her daughter's college tuition. Now her daughter would have to take out loans. A 38-year-old engineer in California had been day trading on the side. He lost $80,000. Money he'd saved over a decade. Gone in hours. The human toll was staggering. Some people couldn't handle it. In the weeks after Black Monday, there were reports of suicides. Traders who'd lost everything. Investors who couldn't face their families. The exact numbers are hard to verify. People don't always leave notes, and families don't always want to admit the cause. But anecdotally, psychologists and crisis hotlines reported a spike in calls. Depression, anxiety, despair, financial ruin leads to mental health crises, and Black Monday ruined a lot of people. But retail investors weren't the only losers. Some professionals got destroyed too. David, the pension fund manager with the portfolio insurance system, lost his job. His $2 billion fund dropped 22% on Black Monday. The portfolio insurance that was supposed to protect him failed spectacularly. The board fired him 3 weeks later. His career in finance was over. Nobody would hire a manager who lost $440 million in one day. It didn't matter that it wasn't entirely his fault. It didn't matter that the models were flawed. He was responsible. He paid the price. Some specialist firms on the NYSE floor went bankrupt. Remember, specialists were supposed to buy when everyone else was selling. They were supposed to use their own capital to stabilize the market. But the selling on Black Monday was too large. They bought millions of shares at $50 thinking they'd sell at $52. But the stocks kept falling to $45, to $40, to $35. They were underwater on massive positions. Some firms lost $50 million, $100 million, more than their entire capital base. They filed for bankruptcy. Their employees lost their jobs. Their partners lost their wealth. The system that was supposed to protect the market destroyed the people running it. The portfolio insurance industry died. LR, the company that pioneered portfolio insurance, saw its business evaporate. Clients cancelled their contracts. Nobody wanted computerized protection anymore. The computers had caused the crash. Why would you trust them to protect you? LR tried to pivot. They tried to rebrand. But it was over. The founders eventually shut down the business. Their elegant mathematical model that was supposed to revolutionize investing had instead caused the worst crash in history. It was a cautionary tale about trusting algorithms over human judgment. But here's the thing about financial markets. For every loser, there's a winner. Black Monday had losers, but it also had winners, big winners. Let's talk about them. Warren Buffett was a winner. Not because he made money on Black Monday, he didn't. His portfolio dropped too. But Buffett had been holding cash for over a year. He'd been warning that stocks were overvalued. Nobody listened. They thought he was out of touch. But Buffett was patient. He waited. And when Black Monday hit, when everyone else was panicking, Buffett went shopping. Monday hit. In the weeks after the crash, he bought stakes in Coca-Cola, Salomon Brothers, and other companies at bargain prices. He'd later say Black Monday was one of the best opportunities of his career. Buy when others are fearful. He did. And he made billions. John Merriweather at Salomon Brothers was a winner. Merriweather ran the bond arbitrage desk. His traders made huge profits during the crash. How? They'd positioned themselves defensively. They'd hedged their risks. And when the market collapsed, their hedges paid off. Merriweather's desk made over $100 million on Black Monday, while the rest of Wall Street was bleeding. It was a masterclass in risk management. Merriweather would later go on to found long-term capital management, which would itself spectacularly collapse in 1998. But that's another story for another video. Short sellers made fortunes. Short selling is when you bet that stock prices will fall. You borrow shares, sell them at the current price, and hope to buy them back cheaper later. It's risky because if the stock goes up, you lose money. Potentially infinite money since stocks can theoretically rise forever. But if the stock crashes, you make a fortune. And on Black Monday, stocks crashed. Hard. Some short sellers made 50% returns in a day. A few made 100%. One famous short seller, a hedge fund manager whose name was never publicly disclosed, made $50 million on Black Monday. He'd been betting against the market for weeks. Everyone thought he was crazy. Turns out he was a genius. Goldman Sachs was a winner. Sort of. They lost money on Black Monday like everyone else, but they positioned themselves better than competitors. They'd reduced their risk exposure in the days before. They'd raised cash. They'd hedged their bets. So when the crash came, they survived relatively intact. And in the aftermath, when smaller firms were failing, Goldman swooped in and took market share. They hired the best traders from failing firms. They won clients who'd lost confidence in their previous brokers. By 1989, Goldman was more dominant than ever. Crisis creates opportunity. Goldman seized it. The Federal Reserve was a winner in a weird way. Alan Greenspan had only been Fed chairman for 2 months when Black Monday hit. It could have destroyed his career. If the financial system had collapsed on his watch, he'd have been blamed. But instead, Greenspan acted decisively. He coordinated with banks. He provided liquidity. He issued the famous statement, "The Fed affirms its readiness to serve as a source of liquidity." He saved the system, and in doing so, he cemented his reputation. Greenspan would remain Fed chairman for 18 years. He'd become the most powerful central banker in history. The maestro, they called him. Black Monday was his first test. He passed. But the question remained, why did it happen? What caused Black Monday? And here's where it gets controversial. Because even today, nearly 40 years later, economists don't fully agree on what caused the crash. Let me walk you through the competing theories, because understanding what caused Black Monday is crucial to understanding modern markets, and to understanding whether it could happen again. Theory 1. Portfolio insurance. This is the most popular explanation. The argument goes like this. Portfolio insurance systems were programmed to automatically sell stock index futures when markets fell. On Black Monday, the market started falling. Portfolio insurance kicked in. Billions of dollars in futures sell orders hit the market. This pushed futures prices down, which pushed stock prices down, which triggered more portfolio insurance selling. It was a feedback loop, a death spiral. The computers were selling to other computers. Nobody was buying. Prices collapsed. Portfolio insurance didn't protect portfolios, it destroyed them, and it took the whole market down with it. The Brady Commission, which was the official government investigation into Black Monday, endorsed this theory. They blamed portfolio insurance for amplifying the crash. They said the systems were poorly designed. The models assumed liquidity would always exist. They didn't account for everyone selling at the same time. The math was elegant, but the assumptions were wrong, and when reality didn't match the models failed catastrophically. But not everyone agreed with this theory. Some academics argued that portfolio insurance was a scapegoat. Yes, it contributed to the crash, but it wasn't the primary cause. After all, portfolio insurance was only managing $60 billion to $90 billion in assets. The total US stock market was worth over $2 trillion. Portfolio insurance was 3% to 4% of the market. Could 3% of the market cause a 22% crash? It seems unlikely. Theory 2. Program trading. This theory says the real culprit was program trading. Remember, program trading is when computers automatically buy or sell baskets of stocks to exploit price differences between stocks and futures. When futures are cheap relative to stocks, the computers buy futures and sell stocks. When stocks are cheap relative to futures, they buy stocks and sell futures. It's arbitrage. It's supposed to keep markets efficient. But on Black Monday, program trading amplified the crash. When futures started falling, program traders sold stocks to match. This pushed stock prices down, which created more arbitrage opportunities, which triggered more program trading. The computers were accelerating the decline. The NYSE blamed program trading. They said the electronic systems were moving faster than human traders could react. The specialists on the floor couldn't keep up. By the time they adjusted their prices, the computers had already traded and moved on. It was like trying to fight a war with muskets against machine guns. The humans were outmatched with muskets, but the Chicago Mercantile Exchange, where futures traded, disagreed. They said the problem wasn't program trading. The problem was that the NYSE systems were too slow. Orders were backing up. Trades weren't being confirmed. If the NYSE had better technology, the crash wouldn't have been as bad. It was a turf war. New York blaming Chicago. Chicago blaming New York. Both had valid points. Both were partially right, but neither wanted to accept full responsibility. Theory. 3. The market was overvalued. This is the simple explanation. Stocks were too expensive. The Dow had risen from 1,000 to 2,722 in 5 years. That's a 170% gain. Price-to-earnings ratios were stretched. The market was priced for perfection. Any bad news would cause a correction. And in October 1987, there was bad news. Rising interest rates, a weakening dollar, budget deficit concerns, geopolitical tensions with Iran. The market looked at all this and said, "We're too high, we need to correct." And it corrected hard, 22% in one day, brutal but rational. The market was just finding a new equilibrium. This theory is popular with traditional economists. It fits the efficient market hypothesis. Markets are always correctly priced. If stocks fell 22%, it's because they were 22% overvalued. Simple, clean. Except it doesn't explain the violence of the crash. If stocks were just overvalued, why did they fall 22% in one day instead of slowly over weeks or months? Why the sudden panic? The overvaluation theory explains the destination but not the journey. Theory 4. Crowd psychology. This theory says the crash was a pure panic, a psychological meltdown. Markets are made of humans. Humans have emotions, fear, greed. When everyone gets scared at the same time, they all try to sell at once. And when everyone sells at once, prices collapse. It's a self-fulfilling prophecy. The crash happened because people thought there would be a crash. So they sold, which caused a crash. There was no fundamental reason. They sold. No rational explanation, just collective fear feeding on itself. This theory is popular with behavioral economists. They point out that markets aren't always rational. Investors make mistakes. They overreact. They panic. Black Monday was a textbook example. The fundamentals hadn't changed. The economy was fine. Corporate earnings were solid. But investors panicked anyway. Why? Because humans are emotional. We're not rational calculating machines. We're scared animals who run when we see everyone else running. But this theory is unsatisfying. It doesn't explain why the panic started on October 19th. Why not October 18th or October 20th? Something triggered the panic. What was it? Crowd psychology explains how the crash spread, but not how it started. Theory 5. It was all of the above. This is probably the closest to the truth. Black Monday wasn't caused by one thing. It was caused by everything. The market was overvalued. Portfolio insurance created a feedback loop. Program trading amplified the moves. Investors panicked. The systems couldn't handle the volume. The specialists ran out of capital. Geopolitical tensions added to the fear. It was a perfect storm. All the ingredients came together at once, and the result was catastrophic. The Brady Commission's report, released in early 1988, essentially endorsed this multi-factor theory. They identified portfolio insurance as the primary catalyst. But they also blamed program trading, inadequate systems, and market structure flaws. They made 16 recommendations to prevent future crashes. Circuit breakers to halt trading if markets fall too fast, better coordination between stock and futures markets, upgraded computer systems, more margin requirements, basically fix everything. And to their credit, most of the recommendations were implemented. Let's talk about what changed after Black Monday, because the crash didn't just destroy wealth, it fundamentally changed how markets operate. The most visible change was circuit breakers. These are automatic halts in trading when markets fall too much too fast. The idea is to give everyone time to think, to prevent panic from feeding on itself. The NYSE implemented circuit breakers in 1988. If the Dow falls 7%, trading halts for 15 minutes. If it falls 13%, another 15-minute halt. If it falls 20%, the market closes for the day. The exact numbers have been adjusted over the years, but the concept remains. Forced pauses to prevent crashes. Circuit breakers were controversial. Some argued they'd prevent crashes. Others argued they'd make things worse by signalling panic. But we now have data. Circuit breakers have triggered multiple times, most famously in March 2020. During the COVID crash, the market hit the 7% circuit breaker 4 times in 2 weeks. Did they prevent a worse crash? Hard to say. But they did give investors time to think. They broke the momentum of panic selling. They probably helped. Probably. The second major change was coordination between stock and futures markets. Before Black Monday, the NYSE and Chicago Mercantile Exchange operated independently. They had different rules, different margin requirements, different systems. When the crash hit, this caused problems. Futures fell faster than stocks. The basis blew out. Arbitrage couldn't work. After Black Monday, regulators forced better coordination, unified margin requirements, real-time data sharing, joint circuit breakers. The idea was to make stock and futures markets act as one integrated system instead of 2 separate systems. The third change was technology upgrades. The NYSE's computer systems had been overwhelmed on Black Monday. They couldn't handle 600 million shares, so the exchange spent hundreds of millions upgrading everything. Faster computers, more bandwidth, better order routing. By 1990, the NYSE could handle 1 billion shares per day. Today, they can handle 10 billion. The technology has improved dramatically. But so has the speed of trading. The arms race between volume and capacity continues. The fourth change was the death of portfolio insurance. Nobody wanted computerized protection anymore. The systems that were supposed to save you had destroyed you. So portfolio insurance as an industry basically ceased to exist. LOR shut down. Other firms pivoted to different strategies. The elegant mathematical models were abandoned. It was a cautionary tale about trusting algorithms blindly, or so we thought. But here's the twist. Portfolio insurance never really died. It just evolved. Today it's called algorithmic trading, high-frequency trading, quantitative strategies. It's the same concept. Computers making automatic decisions based on mathematical models. We just call it different names. And we've convinced ourselves it's different this time. It's not. The fifth change was in Federal Reserve doctrine. Before Black Monday, the Fed's job was to control inflation and promote full employment. Fighting financial crises wasn't explicitly part of the mandate. But after Black Monday, after Greenspan's intervention saved the system, a new doctrine emerged. The Fed will always step in to prevent financial collapse. This became known as the Greenspan put, the implicit guarantee that the Fed won't let markets crash too hard. If stocks fall too much, the Fed will cut interest rates. They'll provide liquidity. They'll save the system. This created moral hazard. If investors know the Fed will bail them out, they take more risks. They use more leverage. They assume they can't lose. And when everyone assumes they can't lose, eventually everyone loses. But that's a problem for the future. In 1987, Greenspan's intervention was necessary. It saved the system. The moral hazard could be dealt with later. So what were the long-term consequences of Black Monday? Here's the surprising part. Not much. The economy didn't collapse. There was no recession. Corporate earnings kept growing. The stock market recovered. By 1989, the Dow was back above 2,700. All the losses from Black Monday had been erased. It was like it never happened. People who held on, who didn't panic sell, got all their money back. People who sold at the bottom, like Robert's retiree client that Jennifer executed orders for, they never recovered. They locked in their losses, they sold low and never bought back in. Their retirement was destroyed. But the market was fine. This created a narrative, a story that people tell themselves. Market crashes don't matter in the long run. Just hold on. Don't panic. The market always recovers. And for Black Monday, that narrative was correct. The market did recover. But that narrative is dangerous because it assumes all crashes are the same. It assumes every crash will recover quickly. And that's not true. The 1929 crash took 25 years to recover. The 2000 dot-com crash took 15 years if you were fully invested in tech stocks. The 2008 crash took 5 years. Crashes are not all created equal. Black Monday happened to be one that recovered fast. But you can't assume the next one will. The other long-term consequence was the normalization of volatility. Before Black Monday, a 2% daily move in the Dow was big news. After Black Monday, 2% moves became routine. The market got more volatile. Swings got bigger. And investors got used to it. This isn't necessarily bad. Volatility creates opportunities, but it also creates risks, and it changes psychology. When you're used to 2% daily swings, you take more risks to achieve the same level of excitement or return. You use more leverage. You trade more frequently. And eventually that leads to the next crisis. Black Monday also changed public perception of markets. Before 1987, the stock market was seen as relatively safe, a place to build wealth slowly over time. After 1987, everyone knew the market can crash violently, without warning. Your retirement can disappear overnight. This scared some people out of the market permanently, but it also attracted a different kind of investor. Risk takers, traders, people who saw volatility as opportunity rather than danger. The composition of market participants shifted, and that changed how markets behaved. Now let's talk about why Black Monday matters today, in 2026, nearly 40 years later, because the lessons of Black Monday are more relevant than ever. The risks that caused the crash haven't gone away. They've gotten worse. First, algorithmic trading. Remember, portfolio insurance was computers programmed to sell automatically. Today, algorithms dominate the market. High-frequency trading firms execute millions of trades per second. Quantitative hedge funds use machine learning models to make decisions. Algorithmic trading accounts for over 60% of all stock trades in the US. 60%. That's more than half the market controlled by computers, and these computers are faster and more complex than the portfolio insurance systems of 1987. They react to news in milliseconds. They identify patterns humans can't see. They execute strategies humans can't understand. And here's the scary part. When markets fall, These algorithms can all decide to sell at the same time, just like portfolio insurance. Except now, instead of $60 billion managed by algorithms, it's trillions. If those algorithms all sell at once, the crash would make Black Monday look like a minor correction. We've already seen glimpses of this. On May 6th, 2010, we had the flash crash. The Dow dropped 1,000 points in minutes, 9%, in minutes. Then it recovered most of the loss within 20 minutes. What happened? Let me walk you through it because it's terrifying. It's 2:32 p.m. on May 6th, 2010. A normal Thursday afternoon. The market's been choppy all day due to concerns about the European debt crisis. Greece is melting down, but nothing extraordinary. Then a large mutual fund decides to sell $4.1 billion in E-mini S&P 500 futures contracts. That's a big order, but not unprecedented. The fund uses an algorithm to execute the sale. The algorithm is programmed to sell at a certain pace based on trading volume. More volume, faster selling. Less volume, slower selling. Sounds reasonable, right? But here's what the algorithm didn't account for. Other algorithms. When the mutual fund's algorithm started selling, high-frequency trading algorithms detected the selling pressure. They started selling too. Not because they thought the market should go down, but because their models said momentum is negative, sell. So they sold. This increased the selling pressure, which made the original algorithm sell faster, which triggered more high-frequency selling. It was a feedback loop, just like Black Monday, computers selling to computers. At 2:41 p.m., just 9 minutes after the initial order, liquidity completely vanished. High-frequency traders who normally provide liquidity by buying and selling constantly pulled out of the market. Their risk systems said, "This is too dangerous, stop trading." So they stopped. And when the high-frequency traders stop, there's nobody left to buy. The market goes into freefall. Individual stocks experienced insane moves. Procter & Gamble, one of the most stable companies in the world, dropped from $62 to $39 in 4 minutes. A 37% crash. In 4 minutes. Accenture briefly traded at 1 penny. 1 cent. A company worth $30 billion trading at 1 cent per share. Apple dropped 10% in a minute, then recovered in the next minute. It was chaos, pure algorithmic chaos. By 2:45 p.m., 14 minutes after it started, the selling pressure eased. The high-frequency traders came back. The algorithms recalibrated, prices recovered. By 3 p.m., the market was only down 3% instead of 9%, but the damage was done. Investors who had stop-loss orders got stopped out at terrible prices. Someone sold Procter & Gamble at $39 when it was worth $62. That loss was real. That person never got their money back. The market recovered. They didn't. The investigation into the flash crash took 5 months. The SEC and CFTC issued a joint report. Their conclusion, the mutual fund's large sale triggered the crash, but high-frequency traders amplified it, and the market structure allowed it to happen. It was a preview of Black Monday, a warning. We have the same problems we had in 1987, just faster, and we ignored the warning. We implemented some safeguards, we banned certain types of predatory algorithms. But the fundamental problem remains. The market is controlled by computers that can panic. In March 2020, during the COVID pandemic, we had another crash. The market fell 34% in 23 days. Let me give you the timeline because it's important. February 19th, 2020. the S&P 500 hits an all-time high of 3,386. Everything's great. The economy's strong. Unemployment's at record lows. Corporate earnings are solid. Then COVID starts spreading outside China. Italy locks down. The virus is coming to America. Investors realize this is serious. February 24th. The market drops 3.4%. Worst day since 2018. But it's just one day. Maybe it's an overreaction. February 25th. Down another 3%. Okay, this is concerning. February 27th. Down 4.4%. Now it's a rout. February 28th. Down another 4.4%. The market just lost 12% in 5 days. But the real crash is yet to come. March 9th. Oil prices collapse. Saudi Arabia and Russia are in a price war. Oil drops 25% overnight. The stock market opens and immediately hits the circuit breaker, down 7%. Trading halts for 15 minutes. When it resumes, the selling continues. The S&P 500 closes down 7.6%. It's the worst day since 2008. March 12th. The circuit breaker triggers again, down 7% at the open. Halted. Resume. More selling. The S&P closes down 9.5%. 2 circuit breaker days in 1 week. This hasn't happened since ever. Not even during Black Monday. Black Monday happened before circuit breakers existed. March 16th, circuit breaker number 3, down 7% at the open. The Fed had cut rates to 0 over the weekend. They'd announced unlimited quantitative easing, and the market still crashed. The Fed threw everything at the problem, and it didn't work. The S&P closed down 12%. 12% in 1 day, the worst day since Black Monday, 1987. March 18th, circuit breaker number 4, down 7% at the open. 4 circuit breakers in 2 weeks. The system was breaking. Banks were running out of cash. Money market funds were experiencing runs. Corporate bonds were collapsing. Even treasury bonds were selling off, which never happens in a crisis. Everything was falling at once. Total panic. By March 23rd, the S&P 500 had fallen 34% from its February high. $11 trillion in wealth vanished. More than the entire GDP of China. Gone in 23 trading days. It was faster than Black Monday. Faster than 2008. Faster than 1929. The fastest crash to a bear market in history. But then the Fed stepped in. And I mean really stepped in. They cut rates to 0. They bought $120 billion in bonds per day. Per day. They backstopped corporate bonds. They backstopped municipal bonds. They backstopped commercial paper. They backstopped money market funds. They created 13 emergency lending facilities. They lent directly to corporations through the Main Street lending program. They basically said, we will buy everything. We will not let the financial system collapse. We will print as much money as necessary. And it worked. The market bottomed on March 23rd. By August 2020, the S&P was back to all-time highs. All the losses erased in 5 months, the fastest recovery from a crash ever. It was miraculous, except it wasn't a miracle. It was the Fed. Printing money. Lots of money. How much money? The Fed's balance sheet went from $4 trillion to $9 trillion in 6 months. They printed $5 trillion. To put that in perspective, that's more than the entire US. GDP in 1982. And what were the consequences? Inflation. In 2021, inflation hit 7%. In 2022, it hit 9%. The highest inflation in 40 years. The Fed had saved the market by printing money. But printing money has consequences. You can't create $5 trillion out of thin air without eventually paying a price. And we're still paying that price. Interest rates had to be raised from 0% to 5.5% to fight inflation. That caused a mini banking crisis in 2023 when Silicon Valley Bank failed. Ripple effects are still spreading. So yes, the Fed can save the market. But at what cost? Each rescue requires more money printing than the last. In 1987, the Fed didn't print money. They just provided liquidity to banks. Total intervention. Maybe $50 billion. In 2008, they printed $1.5 trillion. In 2020, they printed $5 trillion. What will the next crisis require? $10 trillion? $20 trillion? At some point, the cure becomes worse than the disease. At some point, printing money causes hyperinflation or currency collapse. We don't know where that point is, but we're testing it, and every crisis brings us closer. Second, the speed of markets has increased dramatically. In 1987, trades took seconds to execute. Today, they take microseconds. High-frequency traders measure their performance in nanoseconds. The faster your computers, the more money you make. This speed creates fragility. When everyone is moving at light speed, small mistakes get amplified instantly. A glitch in one algorithm can trigger a cascade across the entire market before humans even realize what's happening. We've had multiple mini-flash crashes, individual stocks dropping 20%, 30%, 50% in seconds. Usually they recover, but each incident is a reminder. The system is fragile. The speed makes it fragile. Third, leverage in the system is higher than ever. Leverage means borrowing money to invest. It amplifies gains, but it also amplifies losses. And when markets crash, leverage creates forced selling. Margin calls go out. Investors have to sell whether they want to or not. This accelerates crashes. In 1987, leverage was a problem. Today, it's a bigger problem. Hedge funds routinely use 5 to 1, 10 to 1, sometimes 20 to 1 leverage. Retail investors can trade options and futures with massive leverage. Even safe investment strategies like the 60-40 portfolio sometimes use leverage to goose returns. And when the crash comes, all that leverage unwinds at once. It's a powder keg waiting for a spark. Fourth, the Greenspan put has created massive moral hazard. Investors know the Fed will bail them out, so they take more risks. They assume crashes will be stopped. They assume the Fed will always step in, and this assumption changes behavior. In 2018, when the market fell 20%, investors said the Fed will cut rates, and the Fed did. In 2020, when COVID crashed the market, investors said the Fed will print money, and the Fed did. The pattern is clear: crash, Fed intervention, recovery, repeat. But this game can't go on forever. Each intervention requires more stimulus than the last. Each recovery creates more leverage, more speculation, more risk. Eventually the Fed won't be able to save the market, or the cost of saving it will be too high. Hyperinflation, currency collapse. Something will break. We just don't know when. Fifth, and most importantly, we haven't learned the lesson. Black Monday taught us that markets can crash for no clear reason, that algorithms can panic, that systems can break, that your retirement isn't safe. But we've forgotten, or we've convinced ourselves it's different this time. The algorithms are smarter now, the Fed is more powerful now, the systems are more robust now. But that's what they said before Black Monday. The portfolio insurance models were created by Nobel Prize winners. The smartest minds in finance said the systems were foolproof. They were wrong. What makes us think we're right today? Let me give you some uncomfortable statistics. The S&P 500 has had 5 separate 10% plus crashes since 2000. That's one every 5 years on average. In 2000, the dot-com bubble burst, down 49% peak to trough. In 2008, the financial crisis, down 57%. In 2011, the European debt crisis and US debt downgrade, down 19%. In 2018, the Fed tightening and trade war fears, down 20%. In 2020, COVID, down 34%. 5 crashes in 26 years. And these are just the big ones. There have been dozens of smaller corrections. The market has become more volatile, not less. The crashes are getting more frequent, not less frequent. And each time we act surprised. We scramble. The Fed intervenes. The market recovers. And we forget. Until the next time. Here's what keeps me up at night. We have more algorithms, more leverage, more speed, more interconnection, and more complacency than 1987. The ingredients for a crash worse than Black Monday are all in place. We're one algorithm glitch, one geopolitical shock, one unexpected default away from another catastrophe. And when it happens, it won't unfold over 6 hours like Black Monday. It might unfold in 6 minutes. The circuit breakers might not have time to activate. The Fed might not be able to intervene fast enough. The system might not hold. I'm not saying this will happen. I'm saying it could happen. And we're not prepared. So what do you do with this information? How do you protect yourself? Here are a few thoughts. And these aren't generic investment advice. These are specific, actionable strategies based on what we learned from Black Monday. First, diversification doesn't work in a crash. Every asset class fell on Black Monday. Stocks, bonds, futures, everything. When panic hits, correlation goes to 1. Everything moves together, down. So don't assume your diversified portfolio will save you. It won't. Not in a real crash. The only true diversifier is cash. Boring, inflation-losing cash. But when the market drops 20% in a day, cash looks pretty good. How much cash should you hold? It depends on your situation. But here's a rule of thumb. If you're within 5 years of retirement, hold at least 2 years of expenses in cash. If the market crashes, you have 2 years to wait for recovery without being forced to sell at the bottom. That's what Robert, the dentist, didn't have, and it cost him his retirement. Second, the Fed will intervene, eventually. But there will be a lag, hours, maybe days. During that lag, can you survive? Do you have enough cash to meet margin calls, to cover expenses, to avoid forced selling? If you're using any leverage at all, you need to answer these questions, because in a crash, margin calls come immediately. Your broker doesn't wait. They liquidate your positions if you can't post more cash, and they liquidate at terrible prices, at the worst possible moment. If you can't afford to meet margin calls, don't use leverage. It's that simple. Leverage works great in bull markets. It destroys you in crashes. Here's a specific example. Let's say you have a $100,000 portfolio. You're using 2-to-1 leverage, so you've borrowed $100,000 from your broker to buy $200,000 worth of stocks. The market drops 20% in one day, like Black Monday. Your $200,000 portfolio is now worth $160,000, but you still owe your broker $100,000. Your equity is only $60,000. That's a 40% loss on your original $100,000. Your broker looks at this and says, "You're too risky. We need more collateral. Post $20,000 cash by tomorrow, or we liquidate your positions." Do you have $20,000 cash lying around? Most people don't, so the broker liquidates. At the bottom, you lost 40% instead of 20% because you used leverage. Don't do this. Third, algorithms dominate the market now. You can't beat them, don't try. But you can avoid fighting them. Don't use leverage, don't trade on momentum, don't chase trends. These strategies work until they don't. And when they don't, you get wiped out. I know people who made 50% returns in 2019 trading momentum strategies. They used algorithms to identify trends and ride them. Then March 2020 hit. They lost everything. Not 50%. Everything. Because when momentum reverses, the algorithms that were buying become selling algorithms, and they all sell at once. If you're on the wrong side of that trade, you're done. Instead, focus on fundamentals. Buy companies with real earnings, real cash flow, real competitive advantages. Companies that will still exist in 10 years. This sounds boring. It is boring, but boring works. Warren Buffett is boring. He's also a billionaire. The exciting traders? Most of them blow up eventually. Be boring. Stay alive. Fourth, understand that your retirement is not safe. The 401k system is designed on the assumption of steady 7% annual returns. But returns aren't steady. The market doesn't go up 7% every year. It goes up 30% one year and down 20% the next. If you retire in a year when the market is up 30%, you're golden. If you retire in a year when the market drops 20%, you're in trouble. It's called sequence of returns risk, and it's brutal. Let me give you a specific example. Two people, both with $1 million in their 401k at age 65. Both plan to withdraw $50,000 per year. Person A retires in 2019. The market goes up in 2019. Then it crashes in 2020, but person A has a year of cushion. The market recovers. Person A is fine. Person B retires in 2020. The market immediately crashes 34%. Their $1 million becomes $660,000. They still need to withdraw $50,000 to live. So they withdraw $50,000 from a portfolio that's already down 34%. That's an 8% withdrawal rate. Way too high. The portfolio never recovers. Person B runs out of money at age 78. Same starting amount, same withdrawal rate, different timing, devastating difference. How do you protect against this? De-risk as you approach retirement. This is called a glide path. At age 50, maybe you can afford to be 90% stocks. If the market crashes, you have 15 years to recover. At age 60, shift to 70% stocks. At age 65, shift to 50% stocks. At age 70, shift to 30% stocks. Each shift reduces your upside, but it also reduces your risk of retiring into a crash. Robert, the dentist, was 59 and 100% in stocks. That was a mistake, a costly mistake. Fifth, pay attention to market structure. Circuit breakers exist for a reason. If they trigger, that's a warning sign. Don't ignore it. In March 2020, when circuit breakers triggered 4 times in 2 weeks, that was a signal. The system is under stress. Some people saw that signal and reduced their risk. They sold stocks, raised cash, bought puts for protection. Others ignored it and held on. Both groups survived that crash because the Fed intervened. But next time, the Fed might not be able to save everyone. Pay attention to the signals. What are the signals? Circuit breakers triggering. Volatility index spiking above 40. The Fed making emergency announcements. Treasury yields moving erratically. Corporate bond spreads widening. banks reporting liquidity issues. These are all signs of systemic stress. Any one of them? Maybe it's nothing. All of them at once. Time to get defensive. Raise cash. Reduce leverage. Buy protection. Don't be a hero. The market doesn't reward heroism in crashes. It rewards survival. And finally, remember that Black Monday happened for no clear reason. The economy was fine. Earnings were fine. There was no smoking gun. Just a cascade of selling that fed on itself. It can happen again. It probably will happen again. And when it does, the people who survive will be the ones who were prepared. The ones who had cash. The ones who weren't over-leveraged. The ones who didn't panic. The ones who understood that markets can crash violently and without warning. Be one of those people. Black Monday, 1987, was the worst single-day crash in stock market history. 22.6%. $500 billion gone. Retirements destroyed. Careers ended. Dollars gone. Lives ruined. The financial system nearly collapsed. Only the Fed's intervention saved it. The crash taught us that markets are fragile, that algorithms can panic, that your money isn't safe. But we've forgotten those lessons. We've built an even more fragile system, more algorithms, more leverage, more speed, more risk. And we're telling ourselves it's different this time. It's not different, it's the same, just faster, just bigger, just more dangerous. The next Black Monday is coming. The only question is when, and whether you'll be ready. That's the story of Black Monday 1987. The day Wall Street learned that the future could eat itself. The day computers turned on their creators. The day $500 billion vanished. But most importantly, the day we learned a lesson we've already forgotten. In my next video, I'm breaking down the 2008 financial crisis. The crash that Black Monday tried to warn us about. The crash that proved the system is still broken. Subscribe so you don't miss it. Because if you thought Black Monday was bad, wait until you see what happened in 2008.